Hi, everybody. My name is Emmett Cosgrove, coming to you again on the Mercer Wealth Management Market Outlook series. Today, I'm going to talk to you about global market conditions and their impact on emerging markets. We're going to start off with a quote from none other than Todd Mercer, but what he likes to say is that when the U.S. economy catches a cold, Europe catches the flu, and emerging markets catch cancer. That might seem intense, but I'm going to start with a couple of charts to hopefully illustrate why we believe in that quote. So the first slide, what you're looking at is two benchmarks. The first is in purple, the iShares Core Emerging Markets ETF versus the S&P 500 in orange. This is year to date, so since January 2022. What you'll notice, the numbers in return for the year, we have the S&P 500 down 17.07%, and the emerging markets ETF down 19.76% over the same time period. So only a delta of about 2.6 or 2.7%. You might ask, or you might think that's not that significant. But when you think of that as a percentage of that overall return, it actually is quite significant. On the next slide, we're looking at the same two ETFs, this time just over a 3-year time period. I'd like to highlight about midway through 2020. On the chart, you'll see quite a significant divergence between the performance of the S&P 500 as it accelerates upwards and the emerging markets ETF as it does accelerate upwards, but certainly less so than the U.S. And that was purely a function of the COVID pandemic and the lack of interest or demand of tourism and travel to those countries. Fast forward to close of business yesterday, you'll see the S&P 500 has returned 34.93% versus the emerging markets ETF, which has returned negative 0.46% over that same time period. So to start, let's define what emerging markets are. They are economies or markets that are becoming more and more engaged in the global market system. Think about up-and-coming countries. They're transitioning from low-income, less developed, often pre-industrial, towards more growth-oriented, more modern, and a higher standard of living. The International Monetary Fund, or IMF, classifies 23 countries under this umbrella. Just to name a few of them, we have a great acronym, BRICS, which within BRICS there's Brazil, Russia, India, China, and South Africa. Other side of the coin, we have some examples of developed countries, which of course include the United States, most of Europe, and Japan. Some characteristics or risks that are involved with emerging markets and investing in them include often political instability, infrastructure issues, currency volatility, which we're going to get more in depth to today, illiquid equity from the private markets, and often inefficient or non-existent public markets. The political instability and infrastructure issues are, I'd say, two of the more obvious reasons why investors may stray away from taking on the risk of investing in emerging markets and choosing more safe haven assets. But to a lesser known extent, another risk is the impact of a strong U.S. dollar on those emerging markets, and that's what we're going to get into today. So right now, the U.S. Federal Reserve, and many of you are familiar with this either from other conversations with us, other podcasts, or just turning on CNBC, but the U.S. Federal Reserve is raising interest rates to fight against persistent and very strong inflation. That's one of the things it's doing to fight that. In effect, the U.S. dollar has strengthened and investment interest in dollar-denominated securities has increased. As a fun fact, the dollar has hit a 20-year high dating back to 2001. So there's two primary concerns when it comes to the strong U.S. dollar's impact on emerging markets. One is that capital outflows reversed. So what that means is money that would have otherwise been invested in emerging markets and in the growth of their economies in a lower risk time are now flocking into safe haven assets or towards the stability of a more credible market or country. As rates increase, U.S. Treasuries and dollar-denominated securities also increase in their yield and become more attractive to investors. Also, number two, you have higher interest rates, which makes it more expensive for foreign borrowers and also more expensive for foreign borrowers to pay off their debt. So what do we mean by that? Emerging market economies and businesses within them are often growth countries. For example, the tourism industry, when you travel to Thailand. So companies within there need to finance their capital projects with debt. That means they need to take out a loan in order to fund their expenses and grow. Well, when interest rates in the U.S. rise, the cost of borrowing that money to fund their projects also increases. In addition, it becomes more expensive to pay off the debt that they've already taken out to fund the last project. Those higher interest rates are not good for emerging market economies. Also, with increased financing costs and higher interest rates, the overall incentive for these growth companies to invest and to really conduct business operations goes down. And that just further stifles growth for those markets in those countries. There's also kind of an X factor or the Covet Effect. So we talked about EM countries or emerging market countries having a big focus in tourism often, while of course the demand for tourism during and the COVID pandemic just completely stifled those markets. Now, yes, it has recovered since then, but the damage it did during those times is still being felt. We've also seen defaults on emerging market debt increase to 7.8%, which is the highest since 2001. Okay, and that is our podcast for today. Hopefully I've been able to outline global market conditions and their impact on emerging markets, and in particular, why a strong U.S. dollar makes it harder for emerging markets to perform well. As always, please like, share, talk about our podcast, and we're looking forward to talking to you soon. Thank you.